In today's video, I'll discuss the taxation rules for non-resident Indians on capital gains from their investments in India and other sources of income such as rent or salary. First, I will explain the taxation rules for 5 different types of investment. Interest earned on your savings and fixed deposits in India, capital gains on your stock investments, capital gains on your mutual fund investments, capital gains from selling property, and the taxation on your rental income. Next, I will talk about the deductions that non-resident Indians are eligible for and those that they are not eligible for. Understanding these deductions is important because it will help you reduce your taxable income. Finally, I will explain the Double Taxation Avoidance Agreement (DTAA), which prevents you from paying taxes twice, once in India and once in your country of residence. With that said, let us get started. My name is Kanak and welcome back to my channel. For more content from the world of investing, finance and economics, subscribe to my channel and show your support by liking the video and dropping your thoughts in the comment section below. Alright, let us first understand who qualifies as a non-resident Indian and who does not. According to the Income Tax Act of 1961, there are 2 criteria that define residency in India. The first criteria is that you must spend 182 days or more in India during the previous financial year, that is from April to March, to be classified as a resident Indian. The second criteria is that you must spend 60 days or more in India during the previous financial year and a total of 365 days or more in the 4 years prior to the previous year. If you do not meet this criteria, you will be classified as a non-resident Indian. Now, there are exceptions to this rule for crew members of ships and diplomats, which you can read about in details through the link provided in the description below. Let us now understand how your residency status affects taxation. If you are a resident Indian, the income you earn in a foreign country will be taxable in India. However, if your residency status is non-resident Indian, only the income you earn or accrue in India will be taxable in India. Therefore, if you are an NRI, the income you earn outside of India will not be taxable in India. With that said, let us talk about the first source of income that most non-resident Indians earn in India. That is the interest income on their savings account or fixed deposits held in India. NRIs can open 2 types of bank account: the NRE account, which is non-resident external account, or the NRO or non-resident ordinary account. Let me quickly explain the difference between these 2 accounts before discussing taxation. Both accounts have different features. The NRE account allows you to fully repatriate all of your money back to your country of residence. The NRO account has limitations on the amount of money you can repatriate. Additionally, the NRO account is used to collect income earned in India, whereas the NRE account is primarily used to park foreign income in India and repatriate it later. Now, regarding the taxation on interest income, the interest earned in an NRE account is completely tax-free, making it an attractive option for parking foreign income and earning interest without tax liability. However, the interest earned in an NRO account is taxable. A 30% TDS or tax deductible at source plus surcharge and cess is deducted when the interest is paid. To claim back your TDS, you will need to file a return at the end of the year. And if your total income falls below the taxable limit, the TDS deducted on your interest income in the NRO account will be refunded back to you. For example, if your total income for the financial year 2023 to 2024 is below 2.5 lakh rupees and you file your income tax returns, the TDS deducted on your NRO account interest will be refunded back to you. With that said, let us now talk about the taxes on stocks and mutual funds. The taxation rules are the same for listed stocks, which means stocks that trade on the stock exchange, and for equity mutual funds, which are mutual funds that primarily invest in stocks. Firstly, the taxation on capital gains, that is, the profit booked by selling the stocks or the equity-oriented mutual funds, depends on your holding period. If you hold the listed stocks or equity mutual funds for the long term, which means more than 12 months, a long-term capital gains tax of 10% will be applied. However, the long-term capital gains up to 1 lakh rupees is exempt from taxes. This means you will only pay the 10% tax on profits above 1 lakh rupees. And you must note that the TDS or the tax deductible at source of 10% will be deducted from your profit. If you sell your listed stocks or equity mutual funds before 12 months, a short-term capital gains tax of 15% will be applied. In this case, a TDS of 15% will be deducted from your profits. Now, the taxation on debt mutual funds differs from the taxation on equity mutual funds. Debt mutual funds, which are mutual funds that invest in bonds and other fixed income assets, have different taxation rules. Profits booked on debt mutual funds by selling them before 3 years, that is before 36 months, are considered short-term capital gains and are taxed at your applicable income tax rate. However, if the debt mutual funds are sold after 3 years, The capital gains are treated as long-term capital gains and are taxed at 20% without any indexation benefit. There is no indexation benefit on long-term capital gains of debt mutual fund, which simply means your returns will not be inflation adjusted, but instead you will pay a flat 20% tax on your long-term gains. Finally, unlisted shares, which are shares that do not trade on stock exchange such as the Bombay Stock Exchange or the National Stock Exchange, are taxed differently. Capital gains on unlisted shares sold before 2 years, that is before 24 months, are treated as short-term capital gains and will be taxed at your applicable income tax rate. However, if you hold unlisted shares for more than 2 years and then book a profit, you will be charged a 10% long-term capital gains tax. Long-term capital gains up to Rs 1 lakh is tax exempt, and only profits above 1 lakh rupees will be taxed at a 10% long-term capital gains tax rate. The good news is that the capital gains on unlisted shares benefit from indexation. What does this mean? For example, if you make a capital gains of 10 lakh rupees by selling unlisted shares, indexation will reduce your actual taxable profit to a lower inflation adjusted amount. This means your taxable capital gains will be less because your gains are adjusted for inflation. And finally, TDS on capital gains from unlisted shares will be deducted equal to your applicable tax rate. With that said, let us now discuss the taxation when selling a property as an NRI. If you hold a property for 2 years or more and then sell it for a profit, you'll attract a long-term capital gains tax of 20%. However, if you sell the property before 2 years, you'll face a short-term capital gains tax, which will be the same as your applicable income tax rate. If you sell the property before 2 years, a TDS of 30% should be paid on the short-term gains. Now, the good news is that there are exemptions on long-term capital gains from your property sale. Under Section 54, if you reinvest the money from the property sale to buy a new residential property, you will be exempt from the 20% long-term capital gains tax. You can also buy 2 residential houses against the sale of your investment property, provided your capital gains are below 2 crore rupees. However, you must purchase or construct the new residential property within a specific time frame from the date of transfer. Additionally, after purchasing the new residential property, you must hold it for 3 years. Otherwise, your long-term capital gains exemption will be reversed. Now, if the long-term gains remain uninvested until the income tax return filing due date, then you can deposit the amount in a capital gain account with a designated bank. By investing in a capital gains account, you will be exempt from long-term capital gains tax. But later, you can withdraw this amount for investment within a specific time frame. It's crucial to invest the exact amount intended for exemption. Otherwise, the remaining portion will be subject to long-term capital gains tax. Another provision under Section 54 EC allows you to exempt the long-term capital gains tax by investing in specific government bonds, but within a specific time frame. Remember that only certain government bonds are eligible for exemption on long-term capital gains from selling a property, and the maximum limit on capital gains that can be exempted is 50 lakh rupees. Now let us talk about the taxes on the rental income that you earn as a non-resident Indian from your properties in India. First, regarding the rental income, if you have a property in India and earn rental income from it, that income will be added to your total annual income earned in India and taxed according to your applicable tax slab based on your total annual income in India. And you can see the income tax slabs based on the new tax regime on your screen. However, a 30% TDS should be deducted by the tenant at the time of rent payment. The good news is that you can claim a refund on your TDS if your applicable tax rate based on your total annual income from all the sources in India falls below the 30% rate. One interesting fact is that if you're collecting rent from a resident Indian, you must collect it in an NRO account. If you're renting it out to another NRI, you can collect the rent in an NRE account because money can only be transferred from an NRE account to another NRE account, not from an ordinary account to an NRE account. Regardless of whether you collect the rent in an Indian bank account or repatriate to your foreign bank account, you are liable to pay taxes on your rental income in India. Now here is an interesting benefit as an NRI on your rental income. You can claim a flat 30% standard deduction on rental income, which will reduce your taxable rental income by 30%. You can also deduct the property taxes and the interest paid on your home loan from your rental income. Now let us understand this through an example. Imagine that for a given year, the only income Rohit earns in India is from renting out his property in India. He collects a total of 10 lakh rupees in rent. Rohit can claim a 30% standard deduction, reducing his taxable income by 3 lakh rupees. Additionally, if Rohit paid 1 lakh rupees in property tax and 1 lakh rupees in interest on the home loan, his taxable income will further reduce by 2 lakh rupees. In effect, Rohit's taxable income would be 5 lakh rupees after subtracting the standard deduction, property tax and the interest payment. According to the new tax regime, there is no income tax on income up to 3 lakh rupees, but it is 5% for income between 3 lakh and 6 lakh rupees. So Rohit will effectively pay a 5% tax on his income between 3 and 5 lakh rupees, which amounts to rupees 10,000. Because the tenant already paid 30% or 3 lakh rupees in TDS, while Rohit's actual tax was only 10,000 rupees, Rohit can claim back the remaining 2,90,000 rupees when he files his income tax return. With that said, let us now discuss the deductions available and those that are not available to NRIs. Firstly, just like resident Indians, NRIs can deduct up to 1.5 lakh rupees from their total annual income earned in India under Section 80C. The eligible expenses and investments under 80C include life insurance payments, children's tuition fee, loan repayment for a property in India, stamp duty or registration fee for property transactions, unit-linked insurance plans, and investments made in equity-linked saving schemes. As an NRI, you are eligible to claim deductions on all of these items up to rupees 1.5 lakh. However, under Section 80C, NRIs are not allowed to open new public provident fund account or invest in the national savings certificates or to invest in the post office deposit schemes or the senior citizen saving schemes. The next is Section 80D, where as an NRI, you can claim up to rupees 25,000 in deductions for premium paid on health insurance for yourself, your spouse or your children. If your parents are senior citizens and resident of India, you can claim up to rupees 50,000 for insurance premium paid for them. Additionally, you can claim 50,000 rupees for medical expenses incurred for your resident senior citizen parents. However, you can claim the medical expenses only if your parents are not covered under any health insurance. After this, under Section 80E, NRIs can claim deductions on the interest paid on education loan for themselves, their spouse or their children. Next, NRIs can claim deductions for donations to social causes under Section 80G. Under Section 80 DTAA, NRIs are allowed to deduct up to rupees 10,000 of interest income earned on savings bank account. Finally, unlike resident Indians, NRIs are not allowed to claim deductions for treatment and medical expenses for differently abled dependents or for themselves. Now let us address one of the most popular questions among NRIs. Will an NRI have to pay double taxes both in India and in their country of residence? The good news is that India has signed a double taxation avoidance agreement with more than 90 countries to prevent NRIs from paying taxes twice on the same income. For the taxes you have paid in India on the income generated in India, you can file for an income tax credit in your country of residence and avoid paying double taxes. But to claim the DTA benefits, you need to obtain a tax residency certificate. Double taxation avoidance agreement is a very detailed subject and varies depending on your country of residence. If you are interested in learning more about it, I will create a separate video to talk about the specifics of it. That's all for this video, and if you find this video helpful, then subscribe to the channel and hit the like button.